Welcome back, everyone. Today I'm going to talk to you about the 6 best tax write-offs for real estate investors. Real estate is very unique in that you can get a lot of deductions that you may not think are available and actually offset most or all of your income, which makes it different than almost every other business. Today I'm going to talk about the 6 best ones for real estate investors and how you can take advantage of them today. The first one is the mortgage interest deduction. If you have a loan on your property, which the majority of real estate, you do have a loan, you're trying to use other people's money, it's also very capital intensive, well, a portion of that monthly payment is actually deductible, the interest portion. And that is one of the largest write-offs, if not the biggest write-off for a real estate investor. So you really want to make sure that you're taking advantage of that. So for example, if you have a rental where your income is say $20,000 in gross rents, well, you're not going to pay tax on that full $20,000. You can also deduct the interest expense. So if your mortgage interest is $5,000 for the entire year for 12 months, January through December, then that's $5,000 off the gross rent you collected. So that leaves you with $15,000 that you'd be taxed on before we get into the rest of the deductions. Because remember, our goal is, even though we're cash flowing, to offset as much income as possible. The second biggest deduction for real estate investors is the property taxes. You know, every state is going to have a different level of property taxes. In some states, like maybe Texas, you may have higher property taxes because they don't have an individual income tax, so they have to make up their revenues in other ways. Versus in Arizona, we may have lower property taxes than Texas because we have an income tax here that makes up some of the revenue. But this is another one that you want to pay attention to. It may not be as big of a deduction as the mortgage interest expense, but it makes a big difference. So going back to our example where we had a rental with $20,000 of gross rent, and we've already taken advantage of the mortgage interest deduction for $5,000. So before we take into account property taxes, we're at a $15,000 taxable income. Well, let's say now your property taxes are $2,000. Well, that would reduce our income further. So now we go from the $15,000 we're at down to $13,000, and now we've reduced our income substantially. And now we're going to continue because we still have 4 more big deductions that you can take advantage of to try and get this down to 0. The third deduction, and this is a big one because you just can't have a rental property without a repair coming up at some point. It's just inevitable. And there's all kinds of different repairs that could happen. There's more capital intensive type repairs. Maybe you're thinking of a remodel or refreshing the property to keep it up to date. Or if you purchased a new property, maybe it hasn't been touched since it was built and you really need to spruce it up to attract new renters and get the rents up to where it is. And I'll talk a little bit about those more capital intensive projects versus more of the kind of day-to-day repairs, which would be things like if the refrigerator goes out and you need to replace that, or maybe you have a leaky faucet or something. Those things that just kind of periodically come up that really you're doing just to keep the property in the condition where it can be used and rented. So a repair is something that's less capital intensive, which means it's deductible when you actually incur it. So typically, anything that is not bettering the property in some way is going to be classified as a repair. So like I said, the leaky faucets, if you have to do some recaulking around the bathroom and the tubs and where the water is, if you need to do drywall repair, if you need to repaint the place, all of those are more typical repairs that just have to be done on a somewhat regular basis, and you're able to expense those. Now, when you purchase assets that are used in the property, they're not necessarily part of the real estate, but they are needed in order to rent it. So on residential property, you have your refrigerators and your dishwashers and your stoves. Maybe if you supply the washer and dryers, then you have those type of items. Well, those are technically separate assets that, absent exceptions in the IRS code, you wouldn't be able to deduct in that year. You'd have to depreciate over time. And we talk about depreciation a lot in some of the other videos. So reference those if you want more information. But there is a special exception for property, for personal property, meaning it's not real estate, it's not affixed to the real estate. You can move it around. If it's less than $2,500, then you can just write it off right away. So if you have to purchase a new refrigerator because the old one went out, or maybe you're just upgrading it, you can write that off right away. So make sure that you're not depreciating that, because you're going to lose out on deductions. And as we know, with the current environment, prices are going up. So the more we can deduct, the better. So this is a big one. So let's continue with that example that we had going. And on a typical home, depends on the age how much you will spend on repairs. But let's just say that's another $1,000 on average. But let's keep going because we still have 3 more deductions. Our 4th big deduction is insurance expense. If you have a rental, it's incredibly important to protect the property and yourself with insurance. So you want to make sure that you have that on your properties and you have enough coverage. So talk to your insurance agents, make sure you're taken care of there, because this is another expense that every rental property is going to have, and you want to make sure that you're accounting for it and deducting it appropriately. And the type of insurance, it really depends on your risk tolerance and everything, so the prices can vary widely. But let's just say that that's another $1,500 a year that you're spending on insurance to make sure that you're covered. And it typically will cover the real property, it'll cover some personal property, but this typically is not going to cover your renter's property. So you want to make sure that they have their own coverage, and because that's an expense that they are incurring, that is something that would not be deductible to you. It's just your insurance for the real property and personal property that you own. So that, if that's another $1,500, just to recap on our example where we're at, we have 20,000 gross rents. We've taken off 5,000 of mortgage interest. We've taken off 2,000 of property taxes. We have $1,000 in repairs, and now we're adding another 1,500 of insurance expense, and that brings us down now to a net of 10,500. So out of 20,000 of cash flow coming in, we've now are only being taxed on 10,500, and we still have 2 more major deductions to go to try and get this thing as close to zero as possible. Our 5th deduction is management fees. So you may be able to manage the property on your own to start, and maybe that's a great idea so you can learn more about how to take care of the rental and the important things, so that when you have a property manager, you know what they should be doing and you can make sure you manage them appropriately. So the idea, though, is that you want to, in real estate, not only use other people's money, hence our mortgage interest deduction, but you also want to leverage other people's time, hence management fees, so that someone can actually take care of the day-to-day, finding your tenants, leasing it up, taking care of scheduling repairs, and all the other day-to-day activities, so that you can spend your time looking for more investments and continue to grow. And of course, because this is a regular business expense that you're going to incur, this is another deduction. Typically, if you have single-family homes or a smaller portfolio, you could probably expect to pay 10% of your gross rent on management fees. Of course, if with larger portfolios, say you have 20 units, you can typically start to get that lower with a management company. Maybe you'll pay 8%, some of them going as low as 6%. If it's commercial property, because your leases are typically a little bit longer. You could expect to pay more in the 3 to 5% range depending on the type of property, how many tenants, things like that. So in this example that we've been using, I'm going to say that it's a residential property and we're at 10% of our gross rents. So that's 10% of $20,000 would be $2,000 annually in management fees. So now to recap where we're at as far as our taxable income with these 5 deductions before we get to our last one, which is a big one and arguably one of the most important ones. We're going to start with our $20,000 of gross rent less our $5,000 of mortgage interest deductions. Then we're going to subtract off our $2,000 of property taxes. We're going to take off $1,000 of repairs. We're going to take off $1,500 of insurance expense. And now when we add in our management fees, we're down to $8,500. So now we're only being taxed on $8,500 even though our renter is paying us $20,000. So it's very important to keep track of all of these. Make sure you have good records so that at the end of the year when you give them to your CPA, they're able to include them in your tax return. Our last deduction that we're going to talk about today, and the one that I like the most, is depreciation. And the reason that this is my favorite deduction is because this isn't actually a true expense of the business. It's just this freebie deduction that you get as a real estate investor. And one of the reasons why real estate is the best business from a tax perspective. So depreciation, which we've talked about in other videos, but just to recap, is when you make a major purchase, you don't write off that entire cost in the year you buy it. You take that deduction over a period of time. So in this case, if this is a residential property, let's say it's a single family home and you've bought it for $300,000, a portion of this is not depreciable because it's part of the land, which doesn't go anywhere, so you don't get a deduction for land. And let's say in this case 20% is the land value, the rest is the home. That means of $300,000, $240,000 is depreciable. And residential property, as you know from prior videos, is depreciated over 27.5 years. So you take $240,000, divide it by 27.5, and I'm rounding, but it's about $9,000 a year in depreciation deductions. So if we go through where we had all these deductions and we started at $20,000, and after we had gotten through mortgage interest deductions, property taxes, repairs, insurance, management fees, we were at $8,500 in net income. Well, now with $9,000 of depreciation deductions, which again are not real deductions, because as long as the property value is staying the same or appreciating, which historically it does appreciate, and especially in today's environment with inflation, it's not a true deduction. But now we're writing off $9,000 against our $8,500 of income, which brings us to a negative $500 taxable loss that you could potentially use to offset other income. And that's what makes real estate so great. So again, when you are at the end of the tax year and throughout the year, make sure you're keeping great records. Keep records of what you paid for the property, keep records of all your repairs and all these other deductions so that you can give them to your CPA, take advantage of them, because the last thing you want to do is pay more tax than you're obligated to. Thanks for watching the video. Make sure to like, subscribe, and give me any comments on other topics that you'd like to see in the future.